This is chapter 2, which is really an accounting review. All of you have had accounting at least one class, so this should come hopefully fairly easy to you. So we're going to go through it fairly quickly. I'm going to give you an exercise at the end. Once again, you should have this outline. Fill in the blanks, give you an idea of what we're going to do here. Okay, so here's chapter 2. At the top of your page are kind of the key concepts. Once again, I'm not going to read through those. So, the basics of accounting. Why do we do accounting? It's so we can kind of keep score, so we know where we're at financially with the business and with individuals. So, all of us have our own balance sheet and income statement and cash flow statement. So, if you had to explain to your brother or sister who's in 7th grade, what is a balance sheet? How would you do it when they don't really understand assets, liabilities, and so on? To me, the easiest way is to say, okay, you have a list of everything that you own. Okay? That's on one side of the page. And on the other side of the page is everything that you owe. Because whenever we get money from someplace, we use it to buy stuff, and that is what we own. That's why it should always balance. Okay? So on this side, we call what we own assets, and what we owe liabilities. And from this point on, I'll mostly be referring to liabilities as debt. Same thing, but in finance we talk more about debt than liabilities. And then we also have equity. Okay? So we have two categories of where this money is owed. So debt is like money that's owed to the outside of the firm. So this would be like a bank or a bond holder, people that are not owners of the company. And equity are people on the inside. Okay? So the owners of the firm. So if I started my own business and I took money out of my personal checking account and I put it into the business, that would be equity. Or stockholders. So you could be a large company, Tesla, and Tesla has stock, and if you bought one of those shares of stock, you would be a very small part owner of the company. Okay? So when owners give money, it's called equity. When outsiders give money, it's called debt. Both of these together is money that's technically owed back to those people. So one reason we call this a balance sheet is because the left side should always balance with the right side. Now the other reason is when we look at any of these, if we look at the date, what is the date up here at the top? Is it a particular point in time or is it a period of time? Answer that. Point or period? Okay. Well, if we said period of time, like January through December, what would you put down for inventory? Because it changes all throughout the year. If I asked you what's in your checking account, you would say, well, my balance is whatever, $5. But that's at a particular point in time. That's as of yesterday or this morning or whatever. So another reason we could say this is called a balance sheet is because on a particular point in time, okay, like December 31st, how much did you have in cash? How much did you have in your inventory? How much did you owe the bank? And so on. So it can only be one point in time. What is the balance on that day? All right, so let's put in some of those blanks here. So as I just mentioned, the date is a point of time. On the asset side, everything is listed in order of liquidity. So liquidity simply means how quickly we can convert something into cash. We'll talk more about it in chapter 3, but in essence, cash is like the most liquid because it's already in cash. And then you would have maybe like marketable securities and so on. Okay, we're not going to get into that. And then on the other side, we have liabilities, and so they're listed in order of when they're due to be paid. So you would have your bills that are to be paid right away, and then eventually get to long-term debt. So this is a key formula that you really ought to memorize. I know with these online classes, you can have your notes in front of you, but some of the quizzes will, there'll be a lot of questions, and if you don't have some aspects of this memorized, it's just going to take you that much longer and you may not be able to finish. So any business, major or minor, should really know this basic balance sheet equation. Assets equal debt plus equity. And I'm saying debt, I know it says liabilities here because once again, they're interchangeable. So one thing you got to remember about finance, as with a lot of new topics, subjects area, it's like you're learning a new language. So here you're learning what is liabilities, what is debt, and they're two terms for the same thing. So you can have net profit, you can have net income, you can have earnings, earnings after taxes, all the same thing. Revenue, sales, okay, same thing. So a lot of different terms for the same thing. So when we break down the balance sheet, we have two parts on the asset side. We have current assets, and these are assets that typically get converted to cash within 1 year. So 1 year is kind of the key date here. And then we have fixed assets, meaning that we're not going to typically turn those into cash. So that would be like plant, property, equipment, land, so on. And those would all be what we call tangible. You can touch them, you can feel them, whatever. Intangible would be like patents, copyrights, things like that. So those are not items that you typically convert into cash within a year. On the other side, we have current liabilities, which would be your utility bills, your rent, and so on. You have to pay within a year. Once again, 1 year. It's a key number there. And then long-term debt, pretty self-explanatory. Shareholder equity, this is the amount of money that your shareholders have put into the business, and typically listed by like stock or owner's equity. Something is how you'd see it. Okay, then once again, another term, another part of the language of learning finance is what we call net working capital. So this is like our working capital over here. This is what we call working capital. We talked about this in chapter 1. Capital is our money, working meaning we're using it like daily. So net means we're going to subtract, we're going to take current assets minus current liabilities. Okay? And that's on your page right there. We'll get to it here on the next sheet right here. Current assets minus current liabilities. So current are your two blanks there. Okay? So do you want this number to be positive? Something for you to think about. Do we want it to be positive? Well, would you rather have more cash or more bills? Okay, so yes, you would want it to be positive. You want your current assets to exceed your current liabilities. The higher that number is, the more liquid you are, the better position you are in terms of being able to pay off your debt, at least on a short run basis. Okay? So it's usually positive for a healthy firm. So there you can read about liquidity. I kind of mentioned that a minute ago. This debt versus equity down here, shareholders' equity equals assets minus liabilities or debt. That's just a different way of expressing the balance sheet equation. Assets equal debt plus equity. As long as you know 2 out of the 3, you can always solve for the third one. Moving on. So we have 2 types of balance sheets. We have what we call a market value balance sheet and a book value balance sheet. So when you go online and you look and you want to research, should you buy Amazon stock, and you look at Amazon's balance sheet, which one are you looking at, the book or the market value? Okay? And what is the difference between these two? So if you kind of remember back to accounting, when we talk about book value is you take like the purchase price, whatever you paid for something, I'll just call it like purchase price. So let's just say you bought a piece of equipment for $20,000, and then you have what? If you use it for a while, you have depreciation. So it goes down, whatever, $4,000, and then you have $16,000. This is what we call the book value. Now it could be at any time you go to sell this piece of equipment, it might be worth $17,000. $17,000 where? On eBay, on the marketplace. Okay, so this is like market value. So you have what it's worth on the books, price minus depreciation, and you have what it's worth in the real world, what you might be able to sell it for. Now, they could easily be the same amount. Market value could be higher or lower. So that, in a nutshell, is the difference between market value and book value. So we can do the same when we look at a balance sheet as a whole here. So book value, and this isn't the best explanation, the balance sheet value of the assets, liabilities, and equity. So that's the definition I just talked about, purchase price minus depreciation. Think about market value is if you were to go to the market, if we look at the stock market, the prices of the stock shares are always changing based on market conditions, okay? So this is the price that things can actually be bought or sold. So market value are often very different. Why? I just talked about that. And which is more important to the decision-making process would be market value, because that is what the true value of everything is. Okay? So when you go online, once again, to look at any firm to invest in, which are you going to see, a book value or market value? Well, imagine trying to put together a market value balance sheet for Apple, who has billions of dollars in assets and liabilities and whatever. That means like every quarter you would have to figure out, okay, how much is this building worth? How much are all these delivery trucks worth? How much is our inventory? How much is all this worth if we were to sell it right now? Well, that's really hard to do. So book value is very easy. What did we pay for it? How much have we depreciated? There's the number. Okay. So book value is what you would typically see when you look online. You have to really calculate market value by looking at stock prices. So here's what, just kind of a basic example. This isn't on your notes here, but here we have book value. Okay. Book value, they both add up to 1,100. Okay. Now imagine that your assets are actually worth more than what they are in the book. Okay, so 600 versus 400 and 1,000. So how would that impact the right-hand side of your balance sheet? Well, your debt wouldn't change. You still owe $500 to the bank. So how much would be owed back to the owners, which we'd like equity, because that's money that is owed to the people that own the company, would go up. So this is the same thing as if you were to buy a house. If you were to buy a house for $100,000 and you took out a loan for 20, okay? So this is the price and this is the debt that you took out, your mortgage. You would have $80,000 in equity because you only took out $20,000 loan, which is kind of unusual. Usually kind of be a little bit different. Well, let's say the price went up to $30,000. What would happen? Well, you still owe $20,000 to the bank, but now, okay, now your equity has gone up to $110,000 because the market value went up. Your debt stays the same, which is a good thing. All right. The other major financial statement is the income statement. And in terms of the date at the top of the income statement, it is for a period of time. So typically January through December, the year, or a quarter, or a month, or whatever. Okay? So we say how many sales occurred during this time period. So a lot different than a balance sheet. So when we look at these two financial statements, income statement and balance sheet says, here's kind of our financial position. Here's how much we have. Here's how much we owe. And the income statement is, okay, here's how much business we've done. Here's how much sales we've generated. Here's how much we have in expenses and so on. So the end result is net income, what we also refer to the bottom line. So if we have net income, then we can pay dividends. Dividends go to shareholders. So it's important. So shareholders are the people that own the stock, okay, and they get dividends. Bondholders, okay, receive interest. Okay? Interest is, this is important for you to remember, interest is an expense doing business, okay? Because bondholders are not owners, and if you have to pay them more money than what they gave you, then that's an expense of running your business. Dividends is like saying, okay, you guys own part of this business. We're going to give you some of the profits back of the business that you own. That is not an expense. So that's important to know too. You can write that down. Not an expense. That comes after taxes, after net income or whatever. It's just, okay? So there's two things that businesses can do with their profits. One, pay it out in the form of dividends. Or two, if they don't pay it in the dividends, they're going to keep it in the business. They're going to put it back into the business. So those So that profit, that income, that earnings, all the same, earnings, income, profit, we're going to keep, we're going to retain. So that's money that goes back into the business. And this is going to go under equity because those earnings that we've kept is money that's owed to the owners because that's profit that they've made. So we're going to retain our earnings. So the basic equation for the income statement is simply revenue minus expenses. That gives you your income. That should all be review from accounting class. So we have the GAAP matching principle. GAAP, generally accepted accounting principles, simply means that whenever we have a sale, we would like to have the matching expense to that sale on the same income statement. So you don't kind of have staggered. Our sales appear in next year when all the expenses are this year. We try to kind of match them so that you're really getting a full picture, an accurate picture of what's going on. Okay? Expenses charged against revenue do not affect cash flow. So this is important. This is what we call non-cash items. The biggest one is depreciation. Okay? Depreciation. So what is depreciation? So depreciation is when we buy an asset and we use it and therefore it loses value, and so we say, okay, it depreciated, and that is an expense of doing business because our asset has gone down in value. So here's a question that's going to be on your quiz that most people miss. If depreciation, oops, sorry about that. It's okay, you don't need to see me anyway. If depreciation goes up, what happens to cash flow? Okay, so think about this for a minute. If depreciation goes up, what happens to cash flow? Okay, you have your answer? The answer is it goes up. See, most of you got it wrong. So here we go. Here's why. So let's say we have two firms, A and B. Firm A has sales of 100, firm B has sales of 100, depreciation. Firm A has depreciation of $30, firm B has no depreciation. Okay? So then we have net income of 70 and 100. Let's say we have taxes of 20%. So this is 14, this is 20, and there we have earnings after taxes of 56 and 80. Okay? So what happens to cash flow? Cash flow says for A, because depreciation is a non-cash flow, we don't have to write a check for depreciation. We say we made $56 and we add back in depreciation, which was 30. So at the end of this period, we have $86 in cash. Oops, sorry. For B, we have $80. And we add back in cash flow of 0, and we have $80 left. So what happened when depreciation goes up? Our cash flow goes up. Our net income goes down because we have higher expenses. But here's the big thing. Our taxes go down, which we do have to pay. And therefore, our cash flow goes up. So as our depreciation goes up, so does our cash flow. Okay? Okay, next thing I want to talk about is marginal versus average tax rates. Now, the tax rate has been different tax brackets for years and years and years for corporation, and it's still that way for individuals, but for corporations that just changed a couple years ago, but I still want to go through them because you do it on your personal tax rate, and it could go back to that for corporations. So marginal means, think about it, marginal is on the edges, tax paid on the next dollar earned. So if I make one more dollar, what is it taxed at? And the average is simply how you would calculate it. Average, if I paid $30 in taxes and I had $100 in taxable income, I would pay on average 30%. So if you're considering a project that will increase taxes by $1 million, which tax rate should you use? Okay, so increase. So we're already making a certain amount of money and we're going to do a new project. So at the very end on the margins, we would therefore use marginal. Okay, marginal. So here's a video of kind of how tax brackets work. And this is one of the most misconceived ideas about taxes that I see with Americans when it comes to taxes. So here we go. It's only 3 minutes long.
For 2019. These are tax brackets for 2019. Simple, right? But many of us make a common mistake when looking at this. Let's say my income is $84,000. You might think that puts me in the third bracket, so I would owe the federal government 22% of my income. This is wrong, and it's causing us to have uninformed debates about tax policy. Here's how it actually works. Let's go back to my $84,000 income. Now, instead of thinking of tax rates as brackets, we should think of them as pockets. But first, there's one special pocket we need to talk about. The money we put in this pocket is not taxed. The government automatically lets single people put $12,000 in this special pocket and more for couples. But if you spend a lot of money on things like medical expenses or charitable donations, you can sometimes put in more. These are called deductions. With the $70,000 that's left over, you can start filling up the pockets. The first pocket only has room for $9,700, so I only pay $10,000 for 2019.
Sorry, I'm not sure what's happening there.
Then I pay 12% on the money in the next pocket. And then 22% on the money in this pocket. These are called marginal tax rates, and that's how these brackets actually work. So if I get a raise, that new money goes into the first pocket with empty space. When space runs out, we put it in the next pocket. So the raise, and only the raise, would be partially taxed at 22% and partially at 24%. So when politicians say they want to raise the top tax rate, it doesn't necessarily mean these pockets and your money are affected. They're talking about tax rates on the pockets way over there, which are only used once people have filled in these smaller ones. Marginal tax rates are a pretty simple concept once you get the hang of it. So the next time a politician says the government wants to take away 70% of your income, just send them this video.
Okay, so here are the corporate tax brackets for 2017. And this is how they have been, they've changed over time, but we've typically had tax brackets. Starting about 2 years ago, they went to a flat tax rate. But this is still how individuals are done. So I want to give you practice, and we talk about this more in personal finance, but I just want you to understand how this is done. So suppose your firm earns $300,000 in taxable income. So here are the three questions for you. How much do they owe? That's what we call tax liability. What is the average and marginal tax rate? Okay. So to be able to answer the question, you need to know these numbers here. Okay. So so take a moment. I'll leave these up here. Hit pause and try to calculate that. All right. So here's the answer. So for the first 50,000, every business would pay 15% on that 50,000. So we multiply 15% times 50, and we get 7,500. The next $25,000, okay, the next 25,000 is multiplied by 25% to give you 6,250. The next 25 times 34%, and then we're at 200,000. We have $200,000 left because we're doing 300,000 total. So 200,000 times the 39 gives you that. So there is your, what we call, that's the amount of taxes that you would have owed. Okay? So that's your tax liability. If you were to have made one more dollar, 3,001, it would have been in this tax bracket. So your marginal rate would have been 39%. Okay, right there. Your average rate would be you take your total taxes divided by how much income you had, and on average you were paying 33%. So that's how you do taxes. Now, right now we're at a flat rate of 21% for corporate taxes. So it makes everything really, really simple. But once again, I wanted to show you this way because that's how individuals are taxed. And here are the individual taxes. So here's the category that most of you would be in when you graduate, the unmarried. So that means that everybody that's making the first $9,800 is going to be taxed 10% on that amount. And you see they go up after 40,000, got a big jump there. And then after 163,000, got a pretty big jump there. And we live in what's called a progressive tax system, meaning the more you make, as you can see here, as you go up, the rates go up. So if you're making over $500,000, anything over $500,000, you're paying 37% taxes. Now you may think that sounds pretty high, but we've had as high as 90% back in the 40s for that top number. Okay, so okay, sorry about all that. Okay, so the last thing I want to talk about is an exercise I want you to do. So on the back of your sheet there, of course, you can see this. You have your balance sheet and income statement exercise. So I will post the answers on Blackboard, but I'd like you to try to do your best. So on your piece of paper, you're going to have assets, and then your debts, and equity. And you're probably going to need, and this is of course your balance sheet, you're going to need, and this is for ACE, you're going to need almost the whole piece of paper, maybe do your income statement on another piece of paper. But the way I'd like you to do is different than what you've learned in accounting. In accounting, you use T accounts. So we're going to do something a little bit different. We're going to keep running totals. So let me do the first two for you. So you're going to use cash almost every time. So you got to, underneath cash, you got to leave about 13 lines because you're going to use it a lot. So the first transaction says John Smith puts $10,000 in the cash into his new business. So I'd put $10,000, put a number 1 next to it. And then after every transaction, you should be balancing. So on the left side should equal the right side. So we can call this owner's equity because he put it in 10,000, number 1 there. So you're in balance. Number 2, he borrows 100,000 from the bank. So I'm going to keep, notice what I'm doing here is I'm keeping running totals. So 100 plus the 10 gives me 110, puts a 2 there, and then I have a loan over here of 100, and I have a number 2 there, okay? So the idea is that after every transaction, your balance sheet should balance. You don't have to do T accounts. So kind of spread things out. It doesn't really matter what order they're in, just as long as you know the left side is assets and then debt and equity on the other side. So you might have them all over the place. And then when you get down to number 7, you will be starting an income statement. Once again, try to just spread things out so you can keep running totals in there. So I will post the solutions, but the best way to learn is to try it and screw up. It's actually better to make mistakes first because they show, the research shows that when you make a mistake and then you're shown the correct way, you actually learn it a little bit better. So we want to really encourage you to go through this exercise and then look at the solutions. Okay? If you have any questions, email me or whatever. All right? And that's it for Accounting Review.